Morning, welcome to Ainsley News, midweek today, Wednesday the 10th of March. Continuing on by the In Gold We Trust report by Incrementum today, talking gold versus shares. This is our second preview of the upcoming In Gold We Trust report by Incrementum. The report is arguably the pre-eminent annual report on gold and silver, read by over 2 million people in 2020. On Monday, we gave the context for this epic setup for precious metals, and today we look specifically at gold and how it has performed and why. As we've written extensively over the last couple of weeks, the big news for gold right now is the rising yield in bonds. Here's this chart here. And that playing out in less negative real yields as the inflation genie stays in its lantern for now. Here we go, this chart here as real yields become less negative. Who even thought we'd use that term just a few years ago? And whilst we've seen this weakness in gold since August last year, when zooming out, we can see the trend is still bullish, whether you consider the bottom being 2009 with a bull trap in 2015, or late 2015 as the start of this secular bull market. The chart below shows this is the case against a host of currencies, but particularly those with the most aggressive central banks, headed of course by Japan. In Aussie dollar terms, we'd be sitting around 180 on that scale as our dollar bucked the trend and stayed relatively strong given the RBA was late to the interest rate cutting party. Of course, now we have our central bank joining a select few, including Japan, employing yield curve control, which, as we discussed before, doesn't necessarily have the limits in place of QE. Aussie printers go brr. Here's this chart here showing weakness since summer 2020, but that uptrend is still intact. Few would have predicted the truly epic share market rally in the US after the GFC. That was because no one had lived through QE and to know how it would actually play out. Gold and silver rallied even stronger up to 2011 and 2012 on fears it would play out with inflation. However, all it did was inflate financial assets. The don't fight the Fed trade prevailed and ears were pinned back on the free money rocket. Only now, a decade later, we are seeing the implications of such monetary stimulus, largesse playing out, and large-scale fiscal stimulus joining central bank stimulus to change the game. The following chart we're going to show you of gold versus the S&P 500 tells the story. Here's that here. Stocks have recently outperformed gold. And zooming right back, we can see the epic setup of that previous chart in historic context. Notably, but only gold looks cheap compared to the S&P 500. As one would expect, the chart shows gold spiking during periods of share market turmoil. The negative correlation with shares is the reason many people hold it, almost like insurance. But you will note that 2020 barely registered on that scale. Such was the speed and ferocity of the stimulus response. It was halted in its tracks. But if you look at the year alone in the chart we're going to show you next, you still get a clear picture of this reverse correlation playing out, despite the correction after August into the end of the year. These charts here. Gold did its job well in the tumultuous year of 2020. Looking back over history, the story is a consistent one, as you can see in this next table. Since the Great Depression and each market crash since, the S&P 500 has averaged 37% falls, whilst in the same period gold averaged 10%, or in other words, outperformed by 47%. Check out these numbers here. The gold works well as a portfolio stabilizer. And finally, the following chart is one for the thinkers, the contrarians, and not the FOMOs. It shows the relative performance of gold while compounding annual growth over contextual periods. Firstly, since we commenced this epic credit cycle in 1971, where you can see it has held its own and only materially exceeded by the S&P 500, which is a major recipient of credit. We then have the period since 1999, which heralded the more active participation of central banks, the end of the last gold secular bear market, and the bottoming of that gold S&P 500 ratio, and both the dot-com and GFC crashes. It's no surprise that gold dominated. But just check out the last chart since 2009 and against what we discussed previously. Shares are up strongly, next but distant gold, and then look at commodities in the negative. This plays in perfectly with the thesis that we are at the point where all this debt-based, stimulus-fueled, fundamentalist, high-growth, low-inflation market largesse starts to meet its maker, and gold and silver and commodities in general have their next bull run. is that chart here. Gold did well, both on a relative but also on an absolute basis. Tomorrow, we'll discuss what that trigger may be. Thanks for listening to News Today, everyone. Remember, if you're after the physical stuff, ainsleyBullion.com.au. Into crypto? Keen to check it out, ainsleywealth.com.au. And our own cryptocurrency built and backed by real physical gold and silver and stored at Reserve Vault. Go check out Gold Silver Standard. That's right, a gold standard and a silver standard. We'll catch you tomorrow for more news.